This question tests the recognition criteria for assets under the IASB conceptual framework. An asset is defined as a present economic resource controlled by the entity as a result of past events. An economic resource is a right that has the potential to produce economic benefits. For recognition, the item must meet the definition of an asset and provide useful information in the financial statements. The key issue in each scenario is whether the company controls the economic resource at the reporting date and whether future economic benefits are expected to flow to the entity. Students should remember that ownership alone is not always decisive. The crucial factors are control, rights to future benefits, and whether those rights currently exist at the reporting date. 1. Secret formula for a best-selling sauce. Asset. The formula is a valuable intellectual resource that generates future economic benefits through sales of the sauce. The company controls the formula because it is kept confidential and only known to directors. Therefore, it meets the definition of an asset, even if it may not always be recognized separately as an internally generated intangible under IAS 38. 2. Lucrative contract, due to commence after year-end. Not an asset. Although the contract may generate future profits, a contract to earn future revenue does not itself necessarily represent a present economic resource. The expected future profitability has not yet been earned and does not constitute a recognized asset at the reporting date. 3. Goods held by a third-party agent that cannot be returned. Not an asset. The company has lost control of these goods. Since unsold items cannot be returned and the company no longer controls their use or disposal, the goods should not remain recognized as inventory. 4. Factored receivable with full recourse. Asset. Because the finance company has full recourse, the company retains the significant risks associated with non-payment. In substance, control and exposure to losses remain with the company, so the receivable continues to be recognized. Correct answer: 1 and 4. Key exam tip: when assessing assets, always ask 1. Is there a present economic resource? 2. Does the entity control it? 3. Can it generate future economic benefits? Only items satisfying all 3 conditions qualify as assets. This question tests your understanding of comparability, one of the enhancing qualitative characteristics in the IASB conceptual framework. Comparability helps users identify similarities and differences between economic phenomena. It improves the usefulness of financial information by allowing investors, lenders, and other stakeholders to compare different companies in the same period, the same company over different periods. A common misconception is that comparability means every company must use exactly the same accounting methods. The conceptual framework clearly states that comparability is not the same as uniformity. Companies may use different accounting policies when those policies better reflect the underlying economic substance of transactions. The question asks whether 2 statements about comparability are true. Statement 1. Permitting alternative accounting treatments for the same economic phenomenon enhances comparability. This statement is false. If 2 companies account for the same transaction using different accounting treatments, comparison becomes more difficult. Allowing alternative treatments generally reduces comparability rather than enhances it. Comparability is improved when similar transactions are accounted for in a similar way. Therefore, Statement 1 is incorrect. Statement 2. Comparability requires uniformity. This statement is also false. The conceptual framework explicitly states that comparability is not uniformity. Uniformity means treating all items identically regardless of their economic differences. Comparability, however, requires that similar things are treated similarly. Different things are treated differently. Forcing identical accounting treatment for economically different transactions may actually reduce the usefulness of financial information. Therefore, statement 2 is incorrect. Correct answer: neither 1 nor 2. Both statements misunderstand the conceptual framework's definition of comparability. Alternative accounting treatments generally reduce comparability. Comparability does not require uniformity. Exam tip: remember the IASB phrase, comparability is not uniformity. This is a frequently tested conceptual framework principle in program financial reporting examinations. This question tests your knowledge of the IASB due process for developing an International Financial Reporting Standard, IFRS. Rather than assessing technical accounting rules, it focuses on the sequence of steps followed when creating a new standard. The key phrase is following receipt and review of comments on a discussion paper. Students must understand the normal order of events in the IFRS standard setting process. 1. Identify and research an accounting issue. 2. Establish advisory groups if necessary. 3. Publish a discussion paper, DP. 4. Receive and evaluate public comments on the DP. 5. Publish an exposure draft, ED. 6. Receive comments on the ED. 7. Finalize and issue the IFRS. The discussion paper is an early consultation document that presents possible approaches and invites stakeholder feedback. After reviewing responses, the IASB develops more specific proposals and publishes an exposure draft for further consultation. Therefore, the next step after reviewing comments on a discussion paper is the publication of an exposure draft. A. Publication of an exposure draft. Correct. This is the next formal stage in the IFRS development process. The IASB uses feedback from the discussion paper to prepare detailed proposals and issues an exposure draft for public comment. B. Establishment of an advisory committee. An advisory committee may be established much earlier in the process to assist with research and technical issues. It is not the normal next step after reviewing discussion paper comments. C. Consultation with the advisory committee. Consultation may occur throughout the project, but it is not the formal stage that follows the discussion paper in the due process sequence. D. Issue of a final IFRS. A final IFRS is issued only after the exposure draft stage and after considering comments received on the exposure draft. Correct answer: publication of an exposure draft. Exam tip: remember the sequence. Discussion paper comments, exposure draft comments, final IFRS. This is a frequently tested IASB due process topic in financial reporting examinations.